Hello, I am Chemoze. Welcome to the weekly Market Notes program. This week, the markets were tossed between two opposing poles. On one side, the panic caused by political risk in Turkey. On the other, a glimmer of hope fueled by Fed liquidity signals despite data blindness in the US. In this episode, we will examine how these two forces have brought global assets to a crossroads. We will start with the divergence in global markets, then look into the dangers whispered by bonds, the contrasting stories of gold and silver, and the sharp crash in crypto. And of course, we will turn our focus to Turkey to analyze how record-breaking interest rates and the Istanbul Stock Exchange have withstood this storm. Undoubtedly, the most shocking development of the week came from Turkey. The news of the indictment against Istanbul Metropolitan Municipality Mayor Ekrem İmamoğlu created an almost shockwave in the markets. Following this political development, the 10-year government bond yield skyrocketed to 32.94%. This situation painfully revealed how seriously the market takes political risk and how fragile even correct monetary policy steps can be without political stability. The second striking development came from the riskiest sector, the cryptocurrency market. The leading cryptocurrency, Bitcoin, fell over 24% from its October peak of approximately $126,300, dropping below $96,000. This sharp sell-off technically pushed Bitcoin into a bear market zone and caused serious panic among short-term investors. This section is crucial for gauging the pulse of the global economy and understanding the direction of the main currents affecting local markets. In particular, the political and monetary policy dynamics in the US directly shape global risk appetite and form the basis of our investment decisions. We started the week with good news. The risk of a federal government shutdown in the US has been postponed until January 30th with Senate approval. However, this solution is temporary, and the main issue is the data blindness it creates in the market. According to signals from the White House, the most critical data used by markets to predict the Fed's next move, October inflation and non-farm payroll data, may not be released at all. This essentially means navigating in a sea without a compass for investors. In this environment of uncertainty, interest rate expectations also fluctuated. The likelihood of a rate cut in December decreased to as low as 49%. However, at this very moment, a confusing signal came from Fed officials, an indication that bank reserves are no longer abundant and that the central bank might return to asset purchases, i.e., QE. On one hand, a message of tightening stance. On the other, a potential signal of increased liquidity. This contradictory situation makes it even more difficult for markets to find direction. These developments also reflected on the dollar index. The dollar index, which fell from the 105 level at the beginning of September to the 98 to 99 range in early November, showed a slight recovery this week, closing around 99.2. Technically, the 98.66 level is an important support, and 99.72 is monitored as the first resistance. The EUR-USD pair ended the week around 1.1630, with the 1.1598 pivot level emerging as a key point, and it gained approximately 0.6% against the dollar on a weekly basis. Markets are almost caught in the middle. On one hand, the expectation that the Fed will not cut interest rates supports the dollar. On the other hand, the hint that it might print money again opens a door of hope for risky assets. In this environment of data uncertainty, it is very risky for investors to make sudden decisions based on news flow, just like driving in foggy weather. Let's now look at the S&P 500 to see how this global uncertainty environment has created a divergence among stock markets, especially between technology and broad indices. Let's now look at the S&P 500. This index is not just an indicator, but also a barometer of global investor confidence. So, did this week's barometer show us that a storm is approaching or that the weather will clear up? Let's take a close look at the figures. The S&P 500 index closed the week with a very small loss of 0.05% at 6,734 points. The index is quite close to its historic high of 6,154 points reached on October 30th. Although there was some selling pressure during the week due to Fed concerns, it generally maintained its resistance. Looking at the technical chart, we see that the index found very strong support twice at the 6,655 level, forming hammer patterns. This is a significant sign that buyers stepped in at this level. In the short term, the 50-day moving average at 6,724 is the first support level. Below this level, the critical threshold is the 6,500 mark. Above, the 6,925 point level and the 7,000 psychological level appear as the main resistance zones. The main strength behind this resistance in the index has been strong company fundamentals and resilient consumer spending. Especially the rise in the information technology and communication services sectors is driven by intensive capital expenditures in artificial intelligence. However, there is another side to the coin. This situation essentially leaves the fate of the entire index in the hands of a few tech giants. This represents a structural risk. While the S&P 500 represents the overall market, the story is quite different in the Nasdaq 100, which contains more interest-sensitive technology stocks. The Nasdaq 100 index is not only the clearest indicator of the technology sector, but also of the market's sensitivity to interest rate and liquidity expectations. Movements in this index are a critical barometer for measuring risk appetite towards growth-oriented assets. This week, the Nasdaq 100 diverged negatively from the S&P 500, experiencing a noticeable decline. After reaching a record high of 26,389 points at the end of October, the index quickly corrected in early November, retreating to around 25,000 points, which is near its 50-day moving average. The 25,000 level and the immediate support at 24,600 are critical. This region is the last line of defense for buyers. If this support zone is broken, a further decline towards 24,000 points is expected. On the upside, the first resistance zone stands out at the 25,750 to 26,000 range. The decline in Nasdaq raises the question, is the party over? The artificial intelligence rally pushed stocks up very quickly, but rising interest costs and valuation concerns are now deflating this bubble a bit. The market is becoming more selective with its money. The gap between the resistance of the S&P 500 and Nasdaq's vulnerability could be the main theme in the coming period. To understand the origin of this interest sensitivity in the stock markets, let's now take a look at the US bond market, where borrowing costs are determined. The bond market is the cornerstone of the global financial system. Even the slightest change in the yield curve has the power to influence everything from economic expectations to monetary policy, risk appetite, and corporate borrowing costs. This week, the bond market tried to navigate through conflicting signals from the Fed. The Fed's delay in expectations of interest rate cuts in December put upward pressure on short-term bond yields, especially on two-year bonds. However, the hint that liquidity could be increased again in the future limited the rise in long-term yields, such as 10 and 30 years. It is difficult to speak of a clear market trend. The yield curve, which shows the difference between 2-year and 10-year bond yields, is one of the most important indicators for interpreting market expectations about the future. Think of it as the market's thermometer. Normally, long-term debt has higher interest rates, but when short-term interest rates surpass long-term rates, meaning the curve inverts, the market signals us that a financial storm is expected in the near future. That's why this indicator is so critical. Current credit expansion and market enthusiasm, according to some experts, bear troubling similarities to the speculative environment at the end of the 1920s. We may be witnessing a period that Austrian economist Ludwig von Mises called a crash explosion, where continuous credit expansion drives asset prices to unsustainable levels. The bond market is whispering to us, don't trust the Fed in the short term, but there could be a problem in the long term. Investors should remember that history may not repeat itself, but it rhymes. JP Morgan CEO Jamie Dimon's warning about the private credit market, when you see a cockroach, there are probably more, makes perfect sense at this point. Especially when we hear hints that the Fed might print more money again, it's impossible not to hear the footsteps of the crash explosion cycle that Mises mentioned. Overlooked risks are accumulating just beneath the surface. This "don't trust the Fed in the short term, but there's trouble in the long term" message in the bond market has pushed investors to seek a safe haven even more secure than the dollar. So, where has this flight gone? The answer, as always, is hidden in precious metals. The commodity market, especially gold and silver, plays a role as insurance against global uncertainty, inflation expectations, and the strength of the dollar. Movements in these assets provide important clues for understanding changes in investors' risk perception. Gold spot prices performed strongly this week, gaining over 4% on a weekly basis. It rose to $4,145 during the week and tested $4,171, but closed the week around $4,080. The most critical development was its very strong defense of the psychological support level of $4,000. This shows how determined buyers are at this level. From a technical perspective, $4,144 emerges as a short-term pivot and support point. Below $4,054 and especially $3,999 will be monitored as strong supports. Above, levels of 4,254, 4310, and 4378 present potential resistance points. There is an interesting divergence beneath the surface. While financial markets are rushing into gold by buying into the Fed's potential liquidity increase and data uncertainty, physical demand in the jewelry sector has decreased by 19% in the third quarter. This situation indicates a widening gap between investor demand and real-world usage. Although gold prices remain strong for now, this divergence may signal a need for consolidation. Silver has also joined the rally in gold, closing the week at $50,517. However, there is a very important point to note in this silver rally. It occurred with very weak trading volume. This situation increases the risk of a double top pattern, which is considered a reversal signal in technical analysis. Investors should be cautious about this. We are moving from safe havens to the riskiest realm of digital assets, the dynamic world of cryptocurrencies. The cryptocurrency market is the most extreme indicator of global risk appetite. Being the asset class most quickly and sharply affected by macroeconomic winds makes it an important indicator for measuring market sentiment. And this week, this market was practically bleeding. Bitcoin, after reaching a peak of approximately $126,300 in early October, fell over 24% to $95,185 on November 14th, marking the lowest level in the past 6 months. This decline of over 20% technically placed BTC in a bear market zone. Analysts interpret losing the psychological threshold of $100,000 as a very negative signal. Now, attention is on the support levels below. First, the $94,000, $92,000 range. If this does not hold, a more critical range of $85,000, $86,000 will come into focus. For a possible recovery, Bitcoin needs to surpass $100,000 again and sustainably. Other major cryptocurrencies followed a similar trend. Ethereum declined from its yearly high of $4,200 to $3,275. The 3,090 level is considered a significant support here. XRP, despite positive ETF news during the week, could not escape the selling wave. There was news that Nasdaq received certification to list a spot XRP ETF, but this development coincided with the overall market decline, so it did not support the price. As a result, XRP fell over 7%, breaking the critical 2.30 support level downward. This sharp sell-off in crypto is the clearest sign that the easy money era has ended. When global risk appetite decreases, the first exit is from this market. However, interestingly, while short-term investors are fleeing, institutions like Citigroup and Standard Chartered still have long-term BTC targets ranging from $133,000 to $200,000. This suggests that the current decline could be a healthy correction that clears excessive leverage in the system. After this stormy week in global markets, we are now turning our focus to the domestic market, Turkey. This week, Turkey's economy was primarily influenced not by macroeconomic data, but by the sudden and destructive impact of political shocks on financial stability. This reminded us once again how delicate the balance in the markets is. Looking at the figures, during the week of November 3 to 7, we see approximately $2.4 billion of foreign investment in securities. At first glance, this sounds quite positive. However, upon closer inspection, we understand that $1.8 billion of this amount comes from the Eurobond issuance carried out by the Treasury. In other words, this is long-term borrowing. When we look at the hot money inflow that energizes the market, we see that only a limited $36 million has entered the stock market. So, can we say foreigners are not coming, but locals are also not going into foreign currency? The data largely supports this. Residents have moved away from foreign currency deposits and are directing their funds into gold and TL money market funds. Speaking in numbers, household foreign currency accounts have increased by only 0.2 billion, while corporate foreign currency accounts have decreased by 0.8 billion. The numbers tell us a clear story. Foreigners are unwilling to take on Turkey's risk beyond long-term borrowing. Locals are fleeing from dollars, but due to lack of full confidence in the TL, are seeking refuge in gold. This is a neither with you nor without you situation, summarizing the fragile balance in the market. And as we saw this week, this balance can be instantly disrupted by a single political news event. Let's take a closer look at how Borsa Istanbul fared during the week in this fragile environment. The BIST 100 index reflects the performance of Turkey's largest companies and serves as the primary indicator of risk perception for both domestic and foreign investors. This week, the index's performance provided an opportunity to test its resilience against political shocks. The BIST 100 index closed the week with a decline of 3.28% at 10,565.74 points. During the week, it saw a low of 10,373.75 points and a high of 11,044.47 points. However, what is noteworthy is that the Borsa Istanbul experienced a relatively milder decline compared to the panic in the bond market. From a technical perspective, the levels around 10,550 and 10,500 are monitored as near support zones. On the upside, the first resistance levels are at 10,700 and 10,800. Looking at a broader perspective, the 10,250 level remains an important main support, and the 11,000 level continues to hold significance as a psychological resistance. Let's now move on to our final data set to examine the core dynamics behind this pressure in the market: the exchange rate, interest rate, and risk premium triangle. The USD exchange rate, bond yields, and CDS premiums. These three indicators are essentially the risk report card of the Turkish economy. They are closely interconnected and provide us with the clearest picture of the country's financial health. The USD exchange rate closed the week at 42.33 recording a modest weekly increase of 0.28%. The rate continues to hold its historic high levels above 42 Technically, the 42 level acts as support, while the 43.5 and 45 levels are monitored as potential resistance zones. The UR closed the week with a 0.80% increase at around 49.30 The main event of the week was undoubtedly the sharp sell-off in the bond market. In this wave of sales triggered by news about Istanbul Metropolitan Municipality Mayor Ekrem İmamoğlu, the 10-year bond yield reached 32.94% during the week. The 2-year benchmark bond yield also increased from 39.87% to 20%, indicating how widespread the pressure has become. Turkey's 5-year CDS premium, or risk premium, reached up to 248 basis points during the week, but closed the week with a slight decline to around 244 basis points. As additional information, the central bank's net foreign exchange position was at $45.8 billion as of November 12th. This week, the Turkish markets gave us a harsh lesson. Correct steps in monetary policy are fragile without political stability. The 10-year interest rate of 32.94% is a warning bell indicating that the core problem lies deeper. For foreign investors, the political stability premium has become more important than the inflation premium. We saw what moved the markets this week. So, which data should we focus on next week? Let's look at the economic calendar. Next week, our agenda includes important data both domestically and internationally. However, especially the uncertainty in the US will be at the center of all markets. Domestically, the most important data to be announced is the central government budget balance. This data will be closely monitored by the markets in terms of fiscal discipline and the course of public expenditures, and may impact TL assets. Internationally, the biggest uncertainty of the week will occur in the US. With the reopening of the government, there is an expectation that postponed macroeconomic data will start to be released. We particularly await clarity on the inflation, CPI, PPI, and non-farm employment data schedules. However, signals from the White House indicate that there is still a risk that these data may be delayed or not released at all. Since these data are critical for the Fed's next move, their release could potentially cause very high volatility in the markets. In summary, the main themes of the past week were the escalating political risk in Turkey, data uncertainty originating from the US in global markets, and the divergence among indices. Markets will continue to try to find their direction in this foggy environment. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week, and I wish you a profitable week.